The question on everyone's lips at the moment is, are we at the bottom of the property cycle? And I think we must be extremely close, if not there already. The market is showing all signs of increasing slightly because sales volumes have risen. From May data, they're about 7.5% up from the previous year. Prices look like they have troughed out, so I'm pretty certain we are now at the floor of the market. Prices themselves are down about 20 odd % in Auckland, perhaps higher on the REINZ metric for measuring, but on the CoreLogic data they're down about 17%, so on average I'd say 20% across the board. Prices will probably stay where they're at now. I can't see any big spike up. In fact, even a gradual increase is probably unlikely because affordability metrics are stretched far too far at the moment. With interest rates still climbing slightly because banks are raising rates at the moment, this is making affordability more difficult. So there's probably unlikely to see any great price increase in the next probably 6 to perhaps 12 months. What I have seen is first home buyers are definitely taking a much larger share of the market. They're making up a large proportion of the valuation work that we're doing. In fact, I was out in West Auckland recently in a new subdivision. I was astonished to see so many sold stickers on the real estate boards. That has been a real turnaround for me in the last few months, seeing the number of sales that are actually coming through. Quite surprising. And investors seem to have been sidelined at the moment. They're not taking much in the way of market share. I think that is possibly because they're a little bit scared off by the price falls. There's very low returns from residential investment at the moment. There's increased costs relating to healthy home standards, maintenance, and also getting rid of bad tenants is a bit of an issue for landlords. One of the key drivers I've seen that's affecting the market at the moment is availability of finance. Banks seem to have become a little bit more relaxed around lending. The CCCFA rules have been relaxed and LVR rules have also been relaxed, meaning you don't need as big a deposit as you needed in the past. That's for both investors and first home buyers in particular. So because of that, buyers are just becoming a little bit more active. Unfortunately, coupled with that, there are the rising interest rates, which is quite surprising given the official cash rate isn't expected to change. So these higher borrowing costs are going to keep a lid on any price gains as well, which is another reason that I don't expect prices to take off anytime soon. A couple of other key drivers of the market are the labour market. People have really good job security at the moment, wage growth, so that's encouraging people to think about real estate. First home buyers and so on have great job security, so they've been more active as a result. And the other turnaround, quite surprisingly, is migration. We've seen a huge spike in migration numbers back into New Zealand with an increase of 72,000 net arrivals. That will see a major demand from these migrants for new rentals and possibly purchasing new homes, which can only be good news for the real estate market. One other challenge that existing borrowers have at the moment is they are coming off fixed interest loans which may have been set for 1 year, perhaps 2 years, at extremely low rates, which possibly even 2% or sub 2% interest rates, and they're now seeing huge increases up to potentially 8% for some. So that's a real challenge for borrowers, refixing those loans. Fortunately, a lot of those would have been stress tested anyway at higher interest rates, so they are hopefully going to be affordable. As yet we haven't seen much in the way of mortgagee sales, so that isn't an alarming feature of the market yet, but there could be a bit of pain to be felt yet from those rising interest rates. Development property is one of the areas that has been hit the hardest with price falls. Land values drop for some development land by as much as 40% in Auckland. A lot of that was driven by developers paying very high prices at the peak of the market because they could see great profits out of developing multi-unit projects, because all the zoning now allowed that. But now that the bottom has dropped out of the end housing market, so prices have contracted there, construction costs have gone up, their borrowing costs have gone up, so everything's been piled up against the developer, so they have gone completely cold on acquiring sites, and as a result the values of those have dropped considerably. Prices are now back to what typical mum and dad type purchasers looking just for a home to occupy would pay, whereas they had been completely priced out of the market before because developers were paying these jacked up prices. But there's a silver lining there, because I think development land prices have now come back to the point where the project will be affordable again. I think we've hit rock bottom for the end townhouse or unit that they're constructing. The construction costs have stopped rising. So I think the metrics are probably favouring the developer now, so long as they can get the thing built and sell it down in a reasonable time frame, and they're not left holding their unit ad infinitum for month after month without a sale. One sector of the market that we have seen hit is buyers who purchased off plans perhaps 18 to 24 months ago at the peak of the market. So they might have bought a property in mid to late 2021. The prices have contracted so much now that they probably should walk away from their purchase if they could, because the building that's being constructed now is worth nowhere near close to what they paid at the peak of the market. So someone might have bought a terraced townhouse, say, for $900,000 in West Auckland. That same terraced townhouse today would be selling perhaps for $750,000 to $800,000. So that buyer has lost at least $100,000 in equity when they come to settle. I have seen quite a few cases of that where they've purchased high and we're now valuing low, nowhere near their purchase price. And the irony is that through the boom period, developers would sell off plans, and then when they came close to completion, they would ask for a price increase because they'd argue that they had increased construction costs, etc., increased holding costs, so they needed to sell the units for more. And the buyers, because the market was so red hot, the buyers were willing to pay the extra that the developer was demanding. But now that the table has turned, there's no way in the world a developer would accept a lower price from what they had initially sold at from 2 years ago. So it's very unfair.